Welcome. My name is Mike Cronin, the founder and CEO of ETF Insight. And today we have Ben Harburg, the founder of Core Values Alpha and PM of the Greater China Growth ETF. Welcome, Ben.
Thanks for having me.
And, on Thursday, the Central Bank of China started a major stimulus. Love to hear your thoughts on what the impact will be for investors and any other insight you think that, is this a short-term, long-term move, and what are the long-term ramifications for investors?
Sure. So let me just take a quick step back. We've been investing in the Chinese market since 2015. Have invested over $2 billion here across the full kind of technology, life sciences, consumer stack. Had a very successful run from 2019 to 2021, investing in the Chinese private markets. We continued to do that, but we also opened up this ETF strategy a little less than a year ago. And the thesis for us was fundamentally that we identified a significant information arbitrage on China, that global investors didn't really get the full picture and were probably far more bearish than they should have been, that there was a significant mispricing of equities in the Chinese market, again, relative to their global peers, particularly out of the United States. So a like-for-like business in many instances, and between China and the United States, the American company was trading at 4 times higher PE. So we're talking about, say, a Pinduoduo in China trading at 12 times PE and Amazon trading at 45. We also identified that Chinese equities really felt like they were at the bottom of the cycle. They were as low as they could go. They were really bumping along the ground, and there wasn't a lot more room to go down. And particularly in many instances, you had companies that were trading at the value of the cash on their balance sheet, or even below that, which is just insane by any kind of financial
Yes.
metric. We also identified that China was in a pretty positive kind of economic cycle. So whereas we were starting obviously to see significant inflation in the United States and the need to take measures to curb that, in China we have a deflationary environment. The Chinese government had never deployed any real arsenal of stimulus post-COVID the way that the U.S. had. And so there were tons of tools in their arsenal that we're finally seeing deployed just this week to stimulate the economy. And so to us, that meant that there was pretty minimum downside, but very high upside potential. And a lot of other fundamentals we'll get into later here about why we think there's just a lot of room to run in the Chinese economy. And so we really just bumped along for the last 11 months of our ETF's lifetime, and our ETF is under the ticker CGRO, because China was kind of stuck in this vicious cycle of negativity. You had plenty of negative geopolitical headlines, which include both kind of friction on the military political front between the US and China, and of course economically with sanctions and all manner of other tariffs and actions particularly taken out of the West, and then reciprocal actions taken out of China to kind of fight back and forth on the economic battleground. We also had pretty slow growth numbers coming out of the Chinese economy. We've obviously had all these headlines around demographic issues, regulatory interventions by the Chinese government that were perceived to be anti-entrepreneur, kind of a narrative that the Chinese government doesn't want to make global investors rich, which I think is completely misguided. But all of that combined to essentially produce a pretty flat first year in our ETF. We just kind of bumped, somewhere between 5% up and down, but never again going anywhere too low as well as we expected. And so really just in the last week, we saw a raft of measures. And I mean, it's a list almost too long to comprehend, but it included interest rate cuts, cashed handouts, something they promised they'd never do, currency reserve and capital reserve rate decreases for banks, lower price mortgages or discounts on people's existing mortgages, large triple-digit billion capital injections, more forceful rate cuts, and actions taken to create larger pools of capital to encourage large institutional investors, particularly pension plans and social security, to re-enter or to enter the Chinese public markets. And it's, it wasn't just a one-off announcement. It came on Tuesday, Wednesday, Thursday, Friday. So generating the kind of momentum and buzz that we had hoped to finally get to this point. And so the net result of all of that was just incredible and really unprecedented growth across the types of blue chip names, particularly the ADRs, H shares that we have invested into out of our ETF. And so it's been a great week for us. And to Mike's point, I guess we would call it a surprise, because the Chinese certainly didn't foreshadow this, and they never seem to want to tip their hand and tell you what they're about to do. And sometimes they don't even tell you why they did what they did. But clearly there was thinking here, and it was really to take advantage of the rate decreases from the Fed. And operate in an environment where, because of that rate decrease, they could take some of these measures without currency, depreciation, without hurting the yuan too much. And actually, it's obviously strengthened over the week. So there was certainly method to the madness. But we're incredibly bullish, and the reason we are is because this isn't some bubbly, sugar high government stimulus. This is actions taken by the Chinese government to shore up global as well as domestic investor confidence in local markets, and in global markets where the Chinese equities are being traded, and parallel with a stabilization of the real estate market, which again we thought always was overblown in terms of its impact. We've always said that it was never kind of a Lehman type moment around China, even with the collapse of some of the very large property developers, because a lot of that contagion wouldn't spread to all aspects of the economy, but it certainly did from a psychological effect, and it did kind of at a local, kind of regional government level. But we're really excited, because we think the future holds even further positive news, because we've still done very little to stimulate consumer demand in China. We still have yet to see all of that capital flowing into the Chinese public markets, the institutional capital. And so there's a lot of room still to run here, with equities, in many instances across our portfolio going up 30–40% just over the last week.
So you really think this is part one of sort of a 5 or even a 10-step process that will happen over the next year, 2 years, 3 years?
A lot of this has, it kind of has to have knock-on effects. So one of the biggest challenges we have in China is consumer confidence. And again, if we're looking at the fundamentals and the cyclicality of China versus the United States, I think there's only about $900 billion of household savings sitting on the shelf in the United States. In China, it's $20 trillion. So the money's here. It's just people are afraid to spend it, or at least afraid to spend it at the levels that they were pre-COVID, because they're worried about where their next paycheck is coming from. We have high unemployment rates and salaries that are declining, bonuses that are being withdrawn. Of course, their equity value in their homes, which was their primary store of value, have gone down. And then they had investments in the public markets, particularly the H shares and the A shares, and those have declined precipitously. And so if people here have been actually kind of stumbling around in a malaise of not really knowing how to deal with this environment, where it's just, every bit of news is the blues. And so I think that this spark can help at least improve two of those areas immediately. So the real estate side, hopefully stabilizing at least the fall in home prices by unlocking more access to these markets, by lowering mortgage costs, by lowering interest rates, and then hopefully on the consumption front, of course, people taking advantage of some of these consumer loans and some of the additional capital that's been unlocked there. And then, of course, on the public market side, more capital flowing into the public markets to improve the shareholdings. But then there's the knock-on effect of how will that stimulate consumer behavior? And that's the one, again, where once we unlock that, and some of that $20 trillion that's either sitting on the shelf goes into the Chinese public markets or back onto the high street and the malls in China, that's when we can really see some nice momentum and positive headline implications on the economic front of these measures.
Right. And so, I think that, it sounds like this is a good starting sort of salvo into solving some of these consumer spending issues. What do you see for the next steps? Do you have any sense for what could be some follow-on moves from the central bank or other government actions?
So, what we understand is that there are several measures now being taken to inject, again, triple-digit billions of yuan into the Chinese public markets. And one of the interesting statistics, for instance, is that in the U.S., our public markets are about 30% composed by what we call institutional capital. So, money coming out of pensions, endowments, Social Security. And in China, that's low single digit. So just by encouraging or forcing essentially a lot of that institutional capital into the public markets will already create a significant impact. Our fear has always been that trading the Chinese domestic public markets was a bad was a bad trade because they were largely uninstitutional, a lot of kind of mom and pop day traders that would create huge volatility and scare away institutional investors. So I think that will help stimulate the A shares and hopefully some of the H shares. But the biggest thing here is re-establishing trust with global investors that they can bring their money back into the market and make money. What's been really gratifying for us to hear is some of the biggest names on Wall Street saying, buy everything China, buy ETFs, buy stocks. And it shows you that first up, geopolitics isn't as big a concern for Wall Street as maybe some people thought it was. That and of course it shouldn't be, because buying shares in a company like Alibaba shouldn't be controversial. It's not you're not compromising American national security by buying a part of a cross-border e-commerce company. And likewise. Hopefully, then that starts to trickle down as the share prices in those companies improve, and that they can hire more people, raise salaries, and start to stimulate some of the kind of knock-on downstream effects. Because the problem is that even if the Chinese government unlocked consumer lending today, it doesn't mean that your average individual will really want to take it on board, because they're, again, concerned about their current economic conditions. So we've got to give people confidence to return to the market before we celebrate too quickly.
So it seems like a lot of the hedge funds are on board, but I think the sort of next step is for the financial advisors and the sort of the lower tier investors to really come on board. And I think that's kind of what we're here to do, right? Is to educate people about the overall stimulus program and what other effects it could have within the economy. Are there any other areas that you think, like within the real estate section, part of the program, um, are there any other sort of hidden liquidity events for the consumer?
Well, again, I think that, speaking of RIAs and some of those other types of participants in our ETF market and the US public market, it's completely to be understood and forgiven that they weren't interested in the Chinese market over the last couple of years. The S&P has been ripping. If you were in any of the other kind of Magnificent Seven, you've done incredibly well over the last couple of years. And so you had all that kind of negative headline risk around China, coupled with an incredibly strong value proposition and return profile of the West or out of the US. And then that makes it a no-brainer. Again, our contention when we launched this ETF was that these were counter-cyclical,
Yes.
and because of economic decoupling, as well as supply chain decoupling and all the other types of economic and technological separation that we've seen between the two markets over the course of the last couple of years, that means that they're at a completely different places in their cycle. And so our view is that the American engine can't go on forever. And as it starts to slow, China is the natural alternative market. Others were trying to look towards India or Japan, and I simply don't think the fundamentals, the scale, the maturity, the institutionalization are anywhere, and the ability to deploy significant capital are not there on the scale of China. Meanwhile, China has incredible fundamentals beyond a lot of the things we've just talked about, beyond all the cash sitting on the shelf, and beyond kind of the mispriced fundamentals of Chinese companies relative to their U.S. peers. China is today the global leader in the fifth industrial revolution, right? So anything in the electric vehicle space, in hardware, in
Battery
solar
technology.
panels, in mobile
Yep.
handsets. China is just dominating the markets, both domestically, internationally. Apple, for instance, fell out of the top 5 largest mobile sellers in China just in the last quarter. And that's going to be replicated across the world, where American hardware companies and even their European allies simply aren't building products on the price and specification that could compete with the Chinese. And that again leads to a kind of a virtuous cycle, where when you're using a Chinese handset, you end up using a Chinese app store, you use Chinese built apps. And so that means that when you're buying into Chinese technology companies today, particularly the types that we're investing in, you're getting the access to what we call kind of the next billion consumers, the next highest alpha markets. Which provides a really compelling value proposition. And of course, those Chinese companies are also doing incredibly well, even in the West. TikTok in the social media space, Shein and Temu in the cross-border e-commerce space. China is the global market leader when it comes to building for digital native consumers. They adopted technology just at the right time, and that enabled their own consumers to leap rungs on the evolutionary ladder of technology adoption. And they're doing the same for consumers in Southeast Asia, South Asia, the Middle East, Africa, South America, and of course, even in more mature Western markets. And so all of that would lead one to believe that this kind of narrative around the demise of the Chinese economy was greatly exaggerated. And even fundamentally, the businesses were far more sound than they were given credit for. Of course, Chinese economic growth cannot sustain at a 10% level for
No.
the an indefinite period. So again, I think there's some again, irrationality around expecting China to continue to grow like it's an emerging market. It's not, but it is a now mature, high growth market with huge global appeal, building exactly the right products for the next generation of consumers. And so as you invest in these technology companies and in the ETFs like ours that are ingrained in them, you're getting access to now global businesses that are competing head to head with their American competitors, or operating in a vacuum where there is no American competitor. There's, Apple today has completely priced itself out of any emerging technology market. And so you simply won't find their products in the hands of that next 10 billion consumers. And so, so that would again give us reason to be bearish long-term, particularly again, as these cycles shift and some of that steam comes out of the US economy, at least certainly out of the everyone but the couple big name stocks.
And are there which of the geographic areas you think are the highest growth? You mentioned Southeast Asia, you mentioned the Middle East. Are those the and I think Africa as well? I mean, are those the areas that they're expanding in the quickest?
Yeah.
And are there other areas that you're also focused on?
So again, we're looking at these Chinese hardware makers that are doing really brisk business around the world. And some of the names that you'll find in our ETF, for instance, are people like Xiaomi, who even in a market that is in many ways anti-China for political reasons, like India, are the market leader in handsets. Xiaomi are a top 4 mobile maker across most emerging markets. Transsion is another name that is in our ETF. This is a company that makes most of the both smart and feature phones, or majority of those that are sold in Africa. And again, because of decoupling, you'll recall that in instances, the American corporates like Google were threatening or have pulled their operating systems or application stores out of, say, Huawei-built phones. And the net result of that is that the Chinese began to develop their own operating systems, their own app stores. And so today, when you're, and I think it was a hugely misguided action by these Western corporations, but the net result is that you have, Chinese built hardware with a Chinese curated app store. And so you're going to get a preference for Alipay applications instead of PayPal, and Didi affiliated ride hailing instead of Uber, and Tuja and Xiaozu home kind of rentals instead of Airbnb. And so I think it unlocks a huge amount of downstream consumption off the back of that hardware. And I think that even 5 years ago or so, outside of maybe mobile handsets, I think a lot of folks really dismissed the Chinese competitive threat when it came to some of this kind of key larger hardware, particularly in the automotive space. We were one of the earliest and largest investors in a company called NIO, which is one of kind of the big three next generation Chinese automakers. We also have, I think, Lixing in our, or Li Auto, as it's called, in our portfolio as well on the ETF. But just 4 or 5 years ago in the Middle East, for instance, China represented only about 1% of the car market, both across electric vehicles and combustion engines. Today, it's 20% and rapidly on the rise. And you have companies that are building cars that look very similar to, say, a Range Rover, that are being sold at where the Range Rover is $80,000, these cars are $30,000, and affluent Arabs are buying the $30,000 car because it's almost like a toy for many of them, and has very low downside, but it's of a similar quality as its European competitor or European inspiration. And so I think you'll find this replicating itself over and over. And say nothing again about the brick and mortar of this fifth industrial revolution. So the batteries, the solar panels, and of course the Chinese are now catching up on chips and other kind of core technology that was restricted to them as a result of some of this decoupling. So all that leads us to be extremely bullish long term on kind of the Chinese integrated supply chain on the hardware side. And of course, it gets even easier for the Chinese when you look at more, the software, the softer components. So social networking, social media, where the Chinese are dominating with the likes of ByteDance, which will likely go public in not too distant future. And then, of course, companies like our biggest holding, Pinduoduo, and its product Temu. These are companies that are able to have mastered logistics and supply chain and production such that they can sell reasonably good quality products at just a fraction, at a shockingly low price. And usually the way these products start off is, I think Western consumers kind of laugh at them and think it's a bit of a joke. And all of a sudden you look back and your significant other is buying them online because
Yeah.
they're so cheap that there's no reason not to, which mirrors what we're talking about in the hardware space. So I think you'll see more and more Chinese software and hardware and soft goods and hard goods being purchased because their price point is just too good to pass up.
Well, it also mirrors a little bit what Amazon had done, right? And I think that the EV market is kind of mirroring what Tesla has done, but just doing it at a lower cost, right?
Right, and at a similar or higher specification. I'm an owner of a Tesla X and a Neo ES6, and I think the Tesla X has still maybe a bit more brand cachet to it, but certainly the ES6 is significantly more easy to drive, more comfortable as a passenger, has better integrated technology, better manufacturing, and I think Tesla even themselves, who have profited mightily off of sales into the Chinese market, are feeling the Chinese electric vehicle manufacturers breathing down their neck. And it's everyone. It's Li Auto, it's XPeng, it's NIO, it's Huawei, it's Xiaomi, it's BYD, it's Chery, on and on and on.
Yeah, it's just the EV market, with the batteries and the solar, it really seems to be that new engine that's powering a lot of growth.
Yeah.
Are there any other areas or companies that you want to give us some insight into?
Our view has generally been, and our expectation, and why we've benefited significantly from the pop over the last week, was that as confidence returns for global investors into the Chinese listed equities, it will obviously first go to the blue chip names. So we didn't need to get too creative. So our belief still is that fundamentally companies like Alibaba, Tencent, Baidu are all going to be the first line of recipients here. And we are, as perhaps you're aware, the only actively traded Chinese ETF amongst this kind of leading group. And we think that's critical because we are moving in and out of positions literally day by day. We were burning up the trading floor this week, adjusting and tweaking our holdings to ensure that we grabbed as much of the windfall that we were able to get. And then we'll be adjusting again over the coming weeks as we see the next wave of companies, be they H shares or A share businesses that also stand to benefit from this kind of trickle down effect. So we'll be adjusting that portfolio mix. But again, really leaning into those themes that we've always believed in of integrated global Chinese supply chains, Chinese leadership in e-commerce. And then, of course, another trend that we're really interested in that speaks to the whole consumption story in China is kind of the consumer downgrade. So because people, just because people aren't spending at the same levels that they were perhaps pre-COVID, doesn't mean they've stopped spending, which I think was another mischaracterization of the Chinese economy. Chinese consumers are staying closer to home. They're doing less global travel. They're doing more domestic travel. So we invested in the travel companies. They're buying fewer global brands. They're buying more domestic brands. And that's not just in clothing, but also things like consumables. So for instance, we have a large position in Luckin Coffee because it's been booming domestically. Interestingly, we're going to try to coin a term here. We're calling, we have this concept of dinks in the United States with dual income, no kids. China has actually already, for the last 30 years, largely initiated by the one-child policy. And now, I think as a result of more kind of social shifts that mean younger, higher income earners are moving to cities, more focused on career, less focused on kind of the traditional family building that they were a couple generations ago in China. So China has had this kind of dink concept for 30 years. And then you couple that with the fact that real estate got so expensive and I think the wool has kind of fallen off people's eyes. In China, for generations, you were told the way you store your wealth is you invest in property. You buy your house, you lay it away, it's going to increase in value. You can, then you can, either mortgage it or sell it and, save that money again or give it on to your kids. I think that narrative is falling apart. And that narrative was, by the way, keeping, I think, a lot of that Chinese savings out of the public markets because people preferred something stable like property, even if it wasn't seeing the same kind of exciting volatility of the public markets. I think that narrative is wearing off, which is obviously bad for the Chinese economy in the short term because it was so real estate driven and kind of this real estate virtuous cycle, especially for provinces that were overbuilding on infrastructure and housing. That has to shift, and that will continue to cause some short-term pain. But in the long term, what you have now is you have what we would refer to as dinkors, so dual income, no kids, or real estate. People are opting instead to rent their properties, not buy, or at least not buy what they were targeting previously. And that actually frees up even more discretionary income. So what we've seen today in China is actually an explosion of people spending more money on kind of what we call slow living or experiences. So concert venues are sold out, soccer games are sold out. People are going camping. People are, doing a lot of things that, weren't as normal in China, let's say a decade ago. And they're, more reminiscent of kind of the slow living that we see in more maturing economies, say in Europe and the United States. And so, again, that provides opportunities for investment. And they're still buying, they're just staying closer to home. So, for instance, we've had a strong position in a company called Proya, which is a domestic cosmetics brand. We've invested at times in, of course, domestic food chains and things like that. So I wouldn't at all dismiss the power and the longevity and the growth within the Chinese consumers. I would simply say it's a different profile of a consumer than it was a few years ago. And so we would gravitate towards those types of experiences and slow living and consumption downgrade and international or global brand substitutions that are kind of reminiscent of this type of profile of a consumer. That said, obviously, you saw the ultra luxury stocks pop this week as well, because when money starts coming back in, people can spend more on those higher end goods. But I still think the long term potential is in that consumption downgrade and substitution narrative.
Well, it's very clear that you're an active PM, and as we've seen in the ETF market, active ETFs have boomed over the last 2 years, and it's impossible for index-based ETFs to be as responsive because they only rebalance once or twice a year. So I definitely think that um, the business thesis around active ETFs for China makes a lot of sense, focusing on the growth, which obviously you have a great level of knowledge and experience on. So definitely wish you the best of luck. It sounds like things have really turned the corner. And just closing statements and anything else you want to just mention?
Sure. I mean, on top of everything else we've outlined and the differentiation, we believe in our ETF that again follows our active management of it, our decades of experience here on the ground in Beijing. And again, many of the folks trading Chinese ETFs and equities are sitting in London, New York, or at best Hong Kong, which is a world away from the realities here on the ground in Beijing. Beyond all those differentiators, and again, the fact that we've invested in many of these companies earlier in their life cycle and have known them through from the Series A to their IPO and beyond. The other thing we've done to differentiate ourselves is to build in place a national security and an American values boards to really, again, assess these companies for their merits and whether they do contravene American national security or American values. Because while maybe the public markets are less concerned about geopolitics, it seems, than they were a couple weeks ago, we are still at our core very concerned with ensuring that we're investing in Chinese equities while not contravening American national security and American values. And so we take each one of our names still to a security review board who are composed of ex-government officials that review these names, not only for the kind of headline risk, but for their downstream and upstream kind of supply chain and customers to understand who they're doing business with, where their data is coming from, where their capital is, where their technology is being deployed, to ensure that we are still investing in businesses that our RIAs, our investors, our endowments can take back to their investment committees and feel confident that they're not contravening American interests. And so that has always been at our core and one of our key differentiations. We identified early on that many of our competing ETFs were rife with names that were either sitting on U.S. gray lists or black lists or white lists, or even highly traded blue chip names out of China that we know behind the scenes are doing business, say with the PLA or other kind of parties that simply wouldn't pass that national security review board. So we spend a huge amount of our time in Washington understanding what's coming down the pipe, what types of companies, sectors, industries, profile of business models are going to be sanctioned or are again within the within the crosshairs of Washington. And then again, we're actively trading out of those. So our objective is to kind of let you have your cake and eat it too, which is enjoy the upside of the Chinese growth story, like we have over the last week, particularly, without contravening your own values and those of your country. So we hope that investors think about that when they're selecting an ETF as well.
I think the pensions would definitely appreciate that because that's the kind of due diligence they do. So that makes a lot of sense. Well, thank you very much for your time. It was great to spend some time and really learn about this new stimulus program and about your ETF and all the qualities associated with it. Thanks again.
Thanks.